queue. Hello everyone and welcome to the webcast. My name is Susan and I'm from Zoom. I'm going to go over a quick few Zoom instructions. You're going to be able to ask questions at the bottom of the screen in the Q&A panel. These will be addressed after the panel discussion. Please ensure your company or organisation is in your question for your reference. If you have any technical questions, I will assist you. You can also adjust the views at the very top of the screen if you're on a laptop or desktop. There are sizing options such as fit to screen and also feature to choose side-by-side mode. As a reminder, this webcast will be recorded and you will be sent the details. We'll give it a couple more minutes, but just to let you know those details there. Wonderful. And we will get started shortly. I'll hand over to Chris Dalton from Australian Securitisation. Thanks, Chris.
Thanks very much, Susan, and welcome to this webinar update on the Australian securitisation market. My name is Chris Dalton. I'm the Chief Executive for the Australian Securitisation Forum. And as Susan has mentioned, we will be taking questions at the end of the presentations and panel discussion. You can submit your questions using the Q&A function at the bottom of your Zoom screen, or if you've joined in another way, you could email your questions to asf@securitisation.com.au. We'll try and get through as many as we can tonight, but if we don't, we'll come back to you via email in the next day or so to answer your question. Today's webinar will feature a number of speakers who I will introduce now. Our first presenter is Su Lin Ong, who is the Chief Economist for RBC Capital Markets. Su Lin will provide an update on the Australian economy and its outlook. This will touch on the current state of play, the economy's growth profile, and forecasts for the coming months. She'll also discuss 3 or 4 key issues that are important to the near-term and long-term outlook, and some of these are unique to the Australian situation, including consumer confidence, labour market conditions, policy response from the government and our central bank, and possible economic reforms as we come out of COVID-19. Rob Nicol will be our second presenter, and he will follow Su Lin. Rob is the Chief Executive Officer of the Australian Office of Financial Management, which is abbreviated to AOFM. And the AOFM is the agency responsible for managing the Australian government's financing task and debt portfolio. He will describe recent government initiatives, including the Australian Business Securitisation and Structured Finance Support Funds, which have been established recently. Our third speaker will be Anne-Marie Nagel, a partner with King & Wood Mallesons. Anne-Marie will briefly describe a new and innovating financing vehicle that the Australian securitisation industry has created in collaboration with the AOFM to provide temporary liquidity to small lenders to compensate for the loss of cash flow arising from relief given to borrowers impacted by COVID-19. And in the final session, I'll come back to moderate a panel discussion on the current state and outlook for the Australian securitisation market. Members of the panel include Stephen McGann, who's an Executive Director with JP Morgan Australia, David Castle, who is the Head of Syndication and Sales with Macquarie Bank, and Todd Lawler, a Managing Director with responsibilities for Treasury and Funding with Bluestone, a major non-bank lender in Australia. I would now like to hand over to Su Lin.
Thanks very much, Chris, and good evening, everyone, and thank you for joining us today. I thought I would split my comments on the Australian economy into 2 parts today. First, I want to touch on the current state of the economy and probably more importantly, where we're headed over the next 12 months. And secondly, I'd like to highlight a number of key issues that Chris alluded to that we think are important for the outlook, both near and longer term. So let's start with where we're at the moment, and I think I'd make the following observations. Australia's followed a fairly similar growth path to most developed nations since about February, March, when restrictions were introduced in Australia, and we saw peak restrictions throughout throughout April. which closed down quite significant parts of the economy, especially services. Until the recent breakout in Victoria, the economy's probably held up a bit better than we'd feared. Even with the hit to activity from the bushfire crisis early in the year, GDP in Q1 only contracted by about 0.3%, so fairly modest. We're expecting a much bigger contraction in Q2, around 7.5%, and that quarter very much captured peak restrictions. But we actually have revised that growth number, that contraction of 7.5%, up a little bit. And that largely reflected an earlier easing in nationwide restrictions, which began in May, and some fairly good progress up until recently on the health front. So a 7.5% contraction in GDP in Q2 is huge. It's very significant. It's about in line with a number of other developed nations like the US and Canada, but it's probably considerably better than what Europe and the UK will experience. And our European teams are looking for much more double-digit quarterly contraction there. So a pretty tough Q2 for Australia, but not bad compared to some other parts of the world. We think after what's been a historically weak half one in 2020, that probably the worst from an activity perspective is behind us. The high frequency data is telling us that we've started to see a bit of a recovery in output in the latter part of Q2, basically as the health situation improved and restrictions started to ease. But we remain really cautious, and we have been really ever since the start of this year. And we've long held that any bounce in activity as restrictions were eased and with some pent-up demand was unlikely to be sustained. And we retain a very modest recovery profile really for three key reasons. The first, I think, that's important to highlight is the Australian economy was actually quite weak going into 2020, and I think a lot of people forget that. Growth last year was a bit under 2%, so sub-trend. Private final demand was effectively flat. Inflation persistently sub-target, so below the floor of the Reserve Bank's 2 to 3% target for about the fourth consecutive year. There was a reason the Reserve Bank cut rates 3 times last year to what was then a historic low. So economy didn't really have very much momentum coming into this year. I think secondly, and most importantly, there are a number of structural headwinds for the economy, particularly for consumers. And you can see in that chart there, the one around household debt that's up on your screen, that in particular, very elevated levels of household debt, both from an historic perspective as well as on an international basis. You couple that with stagnant wages, low productivity, and now as we come out in this recovery period, a weak labour market, and we think there's quite a lot of structural challenges for the consumer in particular. And then finally, I guess our third factor was really just uncertainty over the virus, and we were particularly worried about the Southern Hemisphere winter, although I don't think seasons seem to really be too much of a factor here. But nevertheless, it's a smart virus and we don't really understand it yet. So those three factors have always kept us with pretty modest recovery type forecasts and fairly cautious all round. Clearly, the recent developments in Victoria suggests that at least one of these risks has materialised, and possibly sooner than we would like. The outbreak there has effectively triggered a return to almost full restrictions in most of the state, and it's very consistent with our cautious outlook. It will temper the recovery, definitely near term, possibly longer term. Victoria accounts for a bit under a quarter of the nation's output, so it is the second largest state. It accounts for a bit over a quarter of total employment. So we've had to take our Q3 GDP forecast down by a bit over 0.6% to account for the renewed restrictions and lockdown in Victoria. We have a blueprint. We know what happens when you shut economies down, and so it will absolutely have an impact on activity. And I think the Victorian experience is a bit of a warning for other countries. We were on a pretty good path in Australia. It was looking considerably better. Couple of mistakes, a bit of bad luck, and the situation can shift quite significantly. So our concern on Victoria, we know the maths, we can do the impact on activity, but I guess our concern is is a bit twofold around confidence. And the likely setback to confidence, and we do worry about that. The kind of start, stop, start nature of these restrictions is a little concerning, and we worry that it'll have a bigger impact on confidence this time round. And then clearly the bit of bleed through that we're starting to see to New South Wales and some breakouts in New South Wales, the largest state, is also a concern and being watched quite closely. And we're starting in New South Wales to adopt some slightly tighter restrictions as well. So the Victorian situation absolutely bears monitoring. So our GDP forecasts continue really to capture these risks and these three factors. We expect the economy in 2020 to contract by about 3.7%. So it will be historically pretty large, but like I said, probably better than a lot of other developed economies. We don't, though, expect that big loss of output in the first half of this year really to be recouped until 2022. And the bounce that we're seeing in activity is unlikely to be sustained. And that's even assuming further fiscal support. So the risk is by later this year and more into 2021, we return to a pretty subdued pace of activity after some bounce in activity after a large half one contraction. So that's very much the profile that we have for growth. It is challenging, and in particular, our focus remains on households. Household consumption has borne the brunt of this recession to date, and I think it'll be fairly important in determining the shape of the recovery. There's been some resilience so far, particularly in the last couple of months, but we think overall the consumption fundamentals are pretty challenging, and this has implications for housing, clearly. We've also seen a little bit of resilience in housing, and Susan, if you go to the next chart, you can see really the picture in terms of house prices. That dark blue line is an index of nationwide house prices. We've barely seen any move lower from fairly elevated levels at the start of this year. But we think the housing market and the softness will take some time to come through. And that's particularly given that we've had a lot of support from both the government and the banks. So we've had a variety of income support measures in Australia, similar to many other parts of the world. We have a very key and important wage subsidy program here known as JobKeeper, originally for 6 months through to the end of September. The Prime Minister today has just announced an extension of that program for a further 6 months through to the end of March. And while it is at a reduced rate and there's some tiering in the payments, it is nevertheless ongoing support. The banks as well have recently also announced further extension of the mortgage repayment deferrals for another 4 months on top of the original 6. So that takes us through to, I think it's around February of next year. So there's been a lot of assistance that has lent support to both housing and households, but this assistance will be tapered and eventually it will end, even if it's more a 2021 story. And I think when you look at that unfolding scenario coupled with pretty elevated unemployment and a weak labour market, you think about as well lower population growth. We think further decline in house prices, probably about 10–11% in the coming quarters. And it's hard to see how arrears and defaults won't rise from their current levels. And while those current levels are quite low for international standards in particular, I think there are a number of challenges ahead. We'd note that, you know, while arrears for securitised prime for 30 days or more is sitting at about 1.3%, and it is fairly stable, that we'd highlight that COVID-related hardship arrangements, including those mortgage payment deferrals, are not included in the majority of the arrears reporting. And so the data to a degree does understate the household stress. I think a rise in those arrears is likely when some of these support measures are pared back and cease further. And obviously what's really important here is the labour market and how that fares. We've already seen a deterioration, and it's interesting, the Reserve Bank's own research in its recent financial stability report suggested that for every percentage point increase in the unemployment rate, mortgage arrears rate increases by about 0.8. So labour market will be really key as to how this sector unfolds. We think the unemployment rate, which is currently about 7.5%, will lift over the coming months to around 8 to 8.5 by the end of next year, by the end of this year, and still be pretty elevated in 2021. Around 7 to 7.5%. So I think the circumstances are challenging, and we'll see that continue to unfold. So that's a broad snapshot of the current state, where we think things are heading. I think some of the key issues we're focused on, particularly around households. But I would like to touch on maybe 3 issues that I think will be really quite important in the recovery and what it looks like. The first is around confidence, and I have talked about this a little bit, but if you go to the next chart, Susan, and I do apologise, this is a very messy chart. The 2 lines, the light blue line is business confidence and the darker blue line is consumer confidence. All that text is really just around the trajectory of the virus, the restrictions that were put in place, and then when they were lifted, as well as some government support measures. And the key message is really quite simple, despite the messy nature of the chart, in that really the trajectory of this virus and the restrictions have a very big impact on both business and consumer confidence. Big declines in around March, April, at the height of the restrictions and the worst of the health crisis. Quite a decent and quick recovery, but you can see that dark blue line, which is consumer confidence, to the end of July, has declined again in direct response to the Victorian developments. So what we worry about really now, particularly for small to medium enterprises, is that the renewed lockdown and restrictions, the stop-start nature of them, the heightened uncertainty might hit confidence harder this time around and prove potentially more enduring. And that clearly has implications longer term for everything from hiring to CapEx to innovation. So I think confidence really bears watching going forward. The second issue that's key for us, and again I've alluded to if you go to the next chart, is around the labour market. It's really critical. While we're reasonably confident that the maximum labour shedding is behind us, we lost about nearly 900,000 jobs over April and May. We think, like I said, the max in terms of shedding's behind us, but we know it's going to take a long time to recoup those jobs, particularly if growth is pretty subdued and the recovery is fragile and confidence struggles. And so for us, it's important to watch all the suite of labour market indicators. The unemployment rate really does only tell part of the story, and Australia, like many other countries, the unemployment rate's been flattered to some degree by these wage subsidy programs, as well as Australians that have just left the labour force. So we focus very much on the underemployment rate, underutilisation, hours worked, and what participation's doing. And the labour market challenges are really significant. I think they will remain front and centre and the focus of all policymakers. And then I think finally, it's really the action of policymakers that's really critical for us to watch. And we're very much of the view, if you go to the next chart, Susan, that fiscal policy needs to do the heavy lifting in Australia, and it's needed to do that for some time. To date, Australia's deployed about 7% of GDP in terms of fiscal stimulus, mostly at the Commonwealth level. And we've long argued that further support is probably needed. So we were pretty pleased to see the Prime Minister's announcement today and the extension of some of these key measures. I think they're really important in terms of lending support to a fragile and uncertain recovery, as well as key for confidence. And Australia is extraordinarily fortunate. We've done some hard work in recent years. we came into 2020 with the budget almost balanced. And as you can see from this chart, outstanding debt levels pretty low, particularly by international standards. So we have a lot of scope to lend support. And I think at this point, it really is on fiscal policy to do more of the heavy lifting, and it's clearly more effective. And we heard similar sentiment really from RBA Governor Lowe today in a key speech. He remains clearly supportive, I think, of further fiscal measures. I think in part it's a recognition that there are limitations to monetary policy, with the Reserve Bank having just entered into unconventional measures. I don't doubt that they will do whatever is necessary and will step up if needed, but there's a clear reluctance, I think, from the RBA to do much more than what it's already implemented in March of this year around enhanced forward guidance, a yield curve target at 3 years of 25 basis points, QE and stepping into buy bonds when the market is dysfunctional, as well as the term funding facility. So I think there's a sense that they've done a lot, and really the more effective tool now is really around fiscal policy. So we are encouraged by what we see on that front, and Australia's scope to deliver more if needed. So I might stop my comments there. I hope that's giving you some sense of where Australia is at this point, maybe as well compared to a number of other countries. I hope as well it's clear that there are a huge amount of challenges ahead, and that is, I guess, in some ways not dissimilar to other parts of the world, but in particular our household debt levels and some of those concerns will make it tough, but luckily we have some scope on the policy front, so I am encouraged by that. So with that, I might pass over to Rob Nicol, who heads up the OFM and is probably one of the busiest people in Australia right about now. And Rob's going to discuss the new Structured Finance Support Fund.
Thanks, Sue-Lyn. I am going to spend some time tonight just talking to you about a couple of government policy initiatives that impact the securitisation market in particular. Some of you will recall that following the GFC, there was an intervention by the Australian government in securitisation markets through a program for it to invest in RMBS, and that program ran for about 5 years. It involved the government investing in primary market deals, and that was primarily at the point in the GFC back in 2008 following that, to help to keep the infrastructure in place for securitisation as a source of capital for a pretty important part of the market, which is the small lenders and in many cases non-bank lenders. Now, that experience was quite useful for the government, and the success of that program led recently to the government coming into the current situation where it decided that it could lean on that experience, and I'll come to that in a minute. If we could go to the next slide. Thanks, Susan. But there's two initiatives that I'll just talk to you briefly about tonight. And one is about development of the market, and that's the Australian Business Securitisation Fund. And that was launched around April of last year. And the primary objective of that is to further develop the securitisation market in Australia through supporting lenders who are using collateral which is wider in scope than the more traditional and the central part of the market, which is RMBS, but also more importantly, that part of the market where the big banks are very active in the lending space. So I'll come back to that in just 1 second. And the second program is the Structured Finance Support Fund. and that's aimed at maintaining capital flows to small lenders during the pandemic situation. So let's just go to the next slide. Thanks, Susan. So just as an overview, the Australian Business Securitisation Fund, it's $2 billion that's being made available over a period of 5 years. And as I alluded to, the AFM has identified parts of the market which are, we believe, underserviced by lenders, where lenders are struggling to access term funding. And there are a range of reasons for that. But one thing we think a distinguishing feature between some wider parts of the securitisation market in Australia and the RMBS market in particular is that there's actually a lack of relevant data for investors to be able to attract capital because there's a lack of loan performance and other credit risk information. So we believe that this lack of uniform information is leading to a proliferation of smaller entities that lack scale, and also an ability for investors to make informed decisions about the performance of the market that would otherwise attract more capital. Now, the fund that we are administering will invest in a way that we are aiming to encourage lenders to provide industry standardised data. And we have a project team in place with the ASF and some other industry people that we are building a template that will, over time, build a uniform database which we hope investors will be able to access, and also that the ratings agencies will be able to use to provide more ready ratings for some of these investment opportunities. In summary, we think that this data aggregation, transparency in the market and accessibility will help develop the market, and that'll lead to a deeper and more efficient market. So the next slide, please, Susan. Now turning to the Structured Finance Support Fund, this is basically what we would describe as an emergency measure that was put in place back in early April or late March, when the government saw the impact of the pandemic crisis unfolding, and it was put in place as part of a package of measures that included the government itself providing loan guarantees for SME lenders, and the RBA also providing a term funding facility for some of for the large banks and other parts of the banking sector. But there was a gap in this market, and that primarily involves small lenders, and the smaller lenders are mostly non-bank lenders, but there are some small ADIs amongst them. The whole idea of this is to provide support and to continue the flow of credit to the economy through access to capital in securitisation markets for these lenders where they have little or no alternative in terms of getting access to capital. And what we've done is we've put together 3 streams of work. So the first stream is the AFM supporting primary market deals, and we're doing that firstly by direct investment in new deals that are coming to the market. We're also doing that by secondary market activity, where we are buying existing notes from investors, and that's with the objective of recycling capital into these new primary deals. So we are monitoring the market carefully, but the fact that we haven't been called on to be involved in several recent deals suggests that the market's beginning to recover. And we also think that our involvement in the secondary market has not only supported some of these primary deals going ahead, because it's provided a release of capital by existing investors to these new deals, but has also provided some pricing information in the secondary market. The second stream is the AOFM investing in existing warehouses, and that's to replace capital where existing investors have withdrawn. Mostly these are mezzanine level arrangements that we've been investing in. We also have lenders who are not able to meet additional calls for financing, so we are meeting those. And we're also finding circumstances where during this current arrangement, there are some lenders that are looking for credit enhancement because the senior financiers and the warehouse providers are requiring that. And so on a case-by-case basis, we are assessing those proposals and we are investing to keep those warehouse arrangements in place and running. And the third part of the third work stream has been the creation of what we are describing as a forbearance SPV. And that SPV will allow for originators who qualify to get access to liquidity support where their clients are unable to meet interest payments because they've got cash flow problems during the pandemic. And the originators will set up trusts, and those trusts will enter into the SPV. And the arrangement works by the AOFM on behalf of the government being a sole and senior financier. The SPV will issue notes and we will invest in those notes, and those notes will provide the cash and the capital for those trusts and those originators to continue to be able to operate during the pandemic, and at some later date they'll start to pay those notes down through the SPV. Now I'm not going to go into much more detail of that because I'm just about to hand over to Anne-Marie, who will take you through the detail of the SPV arrangements.
Thank you, Rob. As Chris mentioned earlier, I've been privileged to be involved in the collaboration between the ASF and the AOFM to develop the forbearance SPV. My job tonight is to give you a quick overview of that vehicle as shown on the slide. Necessarily, this overview will be a simplified overview because firstly, we have a short window to do it with the other important presentations that we have. And necessarily, I think it is easier to understand the concepts behind it if we take away some of the noise. I'd like to start on the left-hand side of the diagram that you can hopefully see on your screens. The idea here in this forbearance SPV is that many originators through many trusts can participate in this forbearance SPV. So in a traditional securitisation, each originator may establish its own trust for the purposes of receiving funding, but in the interests of establishing a solution that can accommodate the industry as quickly as possible during this pandemic, we have come up with an innovative solution where there is a single forbearance SPV that is funded by the AOFM, and many originators through many trusts may sell their receivables into this forbearance SPV. So on the left-hand side of the diagram, you'll see that for each originator, they may have many participating trusts. Now, depending on the size of the lender, they may have a single trust or they may have multiple trusts, indeed more than 10. Each of those trusts can enter into a new agreement with another member of their originator group. Now, that would typically be the servicer, but it could potentially be another participant in their underlying securitisations. We describe that agreement as a reimbursement agreement, and that is because under that agreement, the originator group will provide a liquidity payment to those trusts, and in exchange for that liquidity payment, those trusts will each agree to reimburse the liquidity payment on agreed terms. That receivable then arises between the trustee of the underlying trust and one of the members of the originator's group. So that is simplified in our structure as showing the relationship between, for example, trustee 1 and participant 1. Now, it's important to note that the receivable we're talking about on the left-hand side of the screen is not one of the underlying receivables that's in one of those trusts. This is a new receivable that is created between the trustee of that trust and a member of the originator group. Nothing in this structure is designed to take assets out of the underlying trusts and put them into forbearance SPV. The idea of this structure is instead to create a new receivable between those trustees and the originator group member, and to sell that new receivable into the forbearance SPV. As both Rob and Chris have foreshadowed as part of their presentations, that enables the smaller lenders in the Australian market to access liquidity for interest payments that have not been able to be met because of COVID forbearance. In particular, it enables the originators to access up to 90% of the missed payment through a liquidity payment. And that liquidity payment comes to terms under those reimbursement agreements. Once we have created that liquidity payment and the consequent reimbursement under the reimbursement agreement, we move on in our diagram towards the middle. And having a receivable, we can now apply more traditional securitisation techniques to securitize that receivable in the forbearance SPV. So each of those originator participants, having created those reimbursement receivables, which have enabled that liquidity funding to be put into their trusts, can then sell those receivables to the forbearance SPV. So we'll see the forbearance SPV in the middle of our diagram, and under that structure, each participant will assign the receivables to the forbearance SPV. But as a corollary of that, bearing in mind the comment that Rob made earlier that the AOFM will be making a senior investment, each participant will also be required to make a Class B first loss contribution. So to provide first loss protection into the structure. Now, a couple of comments here. Firstly, the originators within our smaller lender industry in Australia are not homogenous, nor are the asset classes. So the participants shown on this simplified diagram could be participating in prime resi, they could be participating in non-conforming, auto equipment, credit cards, etc. So the sizing of the Class B protection that the participant is required to provide to the structure will depend on those factors. So what asset classes are included in the underlying trusts? So if a participant wants to access the liquidity funding under this, they will need to enter into a sale and contribution deed. And that sale and contribution deed will provide two things. Firstly, it'll establish the facility under which that participant can sell these reimbursement receivables to the forbearance SPV. And secondly, it'll establish the terms on which they need to make these first loss contributions that are sized according to the asset class. Once that deed is in place, the originator participant can sell receivables relating to many underlying trusts, provided of course that those trusts have been approved for participation in the program. So on any given date, when you're allowed to make a claim under the facility, the participant will be able to look at its book and look at the missed payments, and it will be able to effectively seek to make a liquidity payment to its underlying trusts up to 90%. Once that's been determined, it will propose a sale to the forbearance SPV, and the forbearance SPV will look to purchase those at par if the sale conditions are satisfied, including that the relevant first loss protection has been provided. In order to receive funding to make that purchase, the AOFM will provide Class A VFN funding to the forbearance SPV. A couple of important points here. This is a multi-seller structure. We have many originators participating. However, it is not intended that this structure commingles the reimbursement receivable collateral that is provided by each of these participating originators. Instead, what happens through the structure is that the AOFM will subscribe for a different Class A VFN for each underlying participating originator. And the collections on the reimbursement receivables for those participating originators will be streamed to that Class A VFN and will not be sent to satisfy the obligations of any other participating originator. So although it is a single structure, the single structure is still intended to maintain separation between the participating originators in the way that one would expect. So stepping now to the bottom of the diagram, having passed through the steps in the structure, there are two main phases to this structure. The first one we can see on the bottom of the diagram is the availability period. And this is the period during which the participating originators are able to make claims for these liquidity payments through selling these receivables into the forbearance SPV. During that period, it is not intended that participants are required to reimburse any of those amounts or to pay interest on those amounts, because evidently we're dealing with a liquidity issue here, and so those sorts of requirements may run counter to the problem that we're trying to solve. So during that availability period, we then have the receivables being sold in, but in the ordinary course, and of course unless the originators make a different election, then there's not an expectation that payments will be made. Any interest equivalent amount that accrues on the liquidity payment under the reimbursement agreement will instead capitalise during that period. When we come to the end of the availability period, we move into a payment period. The intention is during this payment period that there'll be a stepped schedule over which there is an expectation that those liquidity payments will be reimbursed. That schedule will step down over an agreed period of time, so 3 years in the case of shorter dated assets or 5 years in the case of longer dated assets, in accordance with an expected schedule. However, the underlying trusts will only be required to make that reimbursement if and to the extent there are available funds to make that reimbursement on the relevant date. That is determined by reference to the level of excess income security. So in an ordinary Australian trust, one might describe that as the residual income security. So although there is an expected schedule during which these payments will be made, there is a condition that the trusts are not required to make that payment unless there are amounts available to make those payments at, for want of a better expression, the bottom of the waterfall. In certain circumstances, another feature to understand from this structure, as we see on the left-hand side, there are a number of different trusts who may participate in respect of a particular participating originator. On certain triggers, each of those trusts may share in assisting to reimburse the reimbursement obligation of another trust in accordance with a formula in the documents. So although the general intention is that each trust will be responsible for its own reimbursement, in certain circumstances it is possible that other trusts may participate in the reimbursement of a particular participating originator's obligations. But again, all streamed within and limited to a participating originator's group of participating trusts. And again, even when these obligations apply, they're always subject to the test noted on the bottom of the slide, which is there need to be amounts available for distribution at the relevant level. Given the time available, I'm going to pause there and take the opportunity to hand now to our panel to lead us into our panel discussion.
Chris, I think you're on mute.
Yes, you're on mute.
Thanks very much, Anne-Marie. We are now at the final part of our webinar, and we have a panel which includes Steve McGann from JP Morgan, David Castle from Macquarie Bank, and Todd Lawler from Bluestone. And what we would like to do is to give you a bit of an update on market activity in the Australian securitisation market. So maybe, Steve, to kick off, could you give us a quick summary of the primary market activity so far this year, and maybe provide some comments in terms of how it compares to activity in 2019 and relative to other markets activity?
Thanks, Chris. So far this year, we've seen 16 deals in Australia, 12 of which were RMBS. If we can just show the first slide. Thanks, Susan. What's interesting is the fact that we've seen relatively healthy volumes since the COVID crisis kicked in. Looking at the slide showing Australian issuance, focusing on the post-COVID period of April onwards, the Australian issuance was 44% of 2019 levels. Whereas if we look at UK issuance, for the same period, we see around 14% of issuance since April versus the same period last year. All of this post-COVID RMBS issuance in Australia has been from non-banks. This is likely due to the fact that the RBA put in place a term funding facility which took effect in early April. This facility gives banks access to 3-year funding at 25 basis points. So there's currently no incentive for the banks to issue RMBS. There's 3 post-COVID deals that I'd like to just highlight quickly. The first is the First Mac 2020-1 transaction where First Mac managed to print $1 billion at the height of the lockdown in late March. This was largely thanks to some key support of investors and the AOFM. It was particularly a good result given the prevailing uncertainty and market conditions at the time. Secondly, La Trobe non-conforming RMBS deal in May, where they printed $1.25 billion, albeit at a time when spreads were relatively high, but they proved that they've got a good investor depth during challenging times. Thanks, Susan. I think we can do away with the slides now. The last transaction that I'd like to mention was the recent First Mac RMBS deal, which was really a resounding success. First Mac decided on a defensive structure here with a shorter dated note and also a longer senior AAA tranche with a 3-year refinance. So a little bit different to what they've done in the past. Demand was so strong for this deal that they managed to upsize to $1.3 billion. And they ended up bringing in over 30 investors, which was well above their typical number of investors at around 10 to 15. It's also worth noting that there was negligible support from the AOFM on this transaction, so that was a great result. So, Chris, overall, the market's more subdued due to COVID, but we're continuing to see a healthy volume of issuance and more recently some robust investor demand.
Thanks, Steve. That's a great snapshot. David, we've been focused on the impact of COVID-19 and Sue Ling's mentioned some of the support programs the government's introduced. So what's your observations of the impact of the pandemic on the performance of Australian mortgage portfolios?
Thanks, Chris. Good evening and good morning, all. Look, I think if you think back to March and April of this year at the height of market volatility, at the height of panic and confusion, there were various news reports saying that up to 10 million Australians could apply for COVID hardship. Now, thankfully, that wasn't the case, notwithstanding obviously the tragic loss of lives since then. The numbers in Australia, I think, on a comparative basis, look relatively good. APRA released some data earlier this month, which was dated 31 May, where they gathered data from Australia's 20 largest ADIs. And what that showed was around 500,000 mortgages are currently on COVID hardship. That represented around 11% of the total balance of loans on those 20 ADIs. I appreciate that there are ADIs printing some COVID hardship numbers, which are probably closer to 5 or 6%. But if you look away from the larger ADIs, the mutuals are showing levels around 3 to 6%. Non-bank prime lenders are showing levels around 2 to 6%. And non-conforming is around that 15 to 25%. I should note that those numbers are based on a portfolio-wide basis. And they're also, obviously not all COVID hardship numbers are available. Those numbers are really from the sort of larger and more regular issuers in the securitisation market. I think if I could just make a few key points about those numbers. I think firstly, look, the larger ADIs really took a blanket approach back in March and April, simply because of the sheer volumes of applications that were coming through the door. I think the non-banks probably had a little more time to ask a few questions, and I think that is reflected in some of those larger ADI numbers. I think the second point is, as I said, confusion in March or April meant that probably more people applied for COVID hardship than actually required it. There's a group of borrowers that applied thinking, for example, they didn't need to repay the interest. There was other groups of borrowers thinking that they were going to lose their job. As it turned out, they didn't lose their job, but they did actually get approval. And obviously those numbers have now actually started to drop out. I think probably the other point I'd make is that lenders offered different terms. So lenders offered, some lenders offered 3 months with a review, 4 months with a review, 6 months with a review. And again, some of those numbers are now starting to drop out of the COVID hardship numbers and revert back to P&I. And look, that's resulted in some issuers seeing a reduction in their COVID hardship numbers. Certainly not a trend, but certainly heading in the right direction.
Thanks very much, David. So Todd, maybe we'll turn to you as an originator. Could you tell us how the pandemic so far has affected origination, levels of refinancing that you're seeing, and sort of, I guess, borrower behaviour and borrower performance in the current environment?
Certainly, thank you, Chris. So I think as an originator, we were very concerned about the quality of book that we were originating. Bluestone, for those of you who don't know, we originate prime mortgages, but also near prime and non-conforming specialist mortgages. Most of our production is prime, but we do go across the spectrum in that way. So we were most concerned about the risk on our book, and also obviously the welfare of our borrowers. So we were very quick, and I think the industry as a whole has been very quick to really, in March, April, review lending criteria and really work to assess a borrower's ability to repay and assess the value of the collateral. And I think certainly in the early days of the pandemic, we found that there was just a degree of uncertainty, so we cut our pipeline significantly and cut our lending. We didn't stop lending, but we really worked hard to make sure that only those borrowers who we could genuinely verify their income and have confidence that they wouldn't be, from a financial perspective, significantly impacted by the pandemic. That meant that we cut initially about 90% of our application flow, and we've been quite happy to lend at a much more subdued rate since then. As time has come on, we have found that March, April would be the majority of when our hardships came in. As a lender who goes across the spectrum, we were in that 15 to 20% range has been our experience for hardship requests. But I would note that since that time, the new applications has come to a trickle. There's been very few new hardship applications in the last month and a half, 2 months. We've also noted that we've started to see some curing of those hardships, and about 30% of our book of what we've seen are starting to cure. At Bluestone, we make a great effort to keep in touch with our borrowers, not just give them a payment holiday. We give them a forbearance if they need it for 1 month at a time, and we contact them at the end of each month. And it's in those contacts we really get colour about what hardships the borrowers are going through and how they want to cure. So that's how we've been able to pull back about 30% of them coming back into performing. The nature of the hardship is also interesting in that we have quite a few of the obvious industries that have been impacted of where our borrowers earn their income. And I'd say also some of them, for example, retail is actually starting to come back, we've noted, a little faster than some of the other industries, which we found interesting. And so overall, I would say that we have now and I think the whole overall market, with the impact of the securitisation markets, as Stephen described, coming back, we've been able to do at least one deal so far. And with that, and with some degree of certainty around what parts of the economy are functioning versus others, it's given us the ability to start lending a little bit more freely and pick up volumes, but albeit on a much more subdued and careful way.
Great, thanks, Todd. So, Steve, let's go back to the AOFM's initiatives, and maybe you could comment on both the market and sort of investor perceptions of their involvement since March, and what's been sort of the level of interest in securitised products, both from domestic and international investors since the pandemic commenced.
Yeah, sure. So just starting with the AOFM support, I think what the AOFM give is execution certainty that the issuers need to get out there. And I think the market welcomes that execution certainty. So overall, I think it's the AOFM's involvement is definitely being viewed positively. The way the SFSF has been set up avoids a situation where the AOFM is falsely driving in spreads. The mechanism of providing support through secondary purchases seems to be working quite well. It's probably worth looking briefly at the levels of support the AOFM's provided in recent months. If we look at the percentage of support provided through either primary or secondary purchases, it's been around 17 to 20% for prime issuers and around 25 to 42% for non-conforming deals, with Liberty and La Trobe being the notable exceptions there, having had around 10% support. But more interestingly, what we're seeing is less support in the recent deals. As I mentioned, First Mac only had a small amount of support, and the debut self-managed super deal from RMBS deal from Columbus didn't need any AOFM support at all. So we're already seeing some signs of the AOFM achieving their desired objective of getting the market functioning again without their involvement. On the investor demand side, we're seeing robust demand from both local and offshore accounts. The recent deals we've been on, we've seen a lot of real money accounts in the market, in addition to fairly solid demand from the Asian accounts. This is including both Singapore and more recently Japanese investors coming back. And we're also seeing good interest re-emerging from some key European investors.
Thanks very much. Well, maybe continuing on, David, with the impact of the pandemic, have you noted any changes to transaction structures or preferences of investors being reflected in more recent deals?
Yeah, absolutely, Chris. So I think, certainly agencies have looked at structures and have made some changes. I think the key point is that AAA requirements are largely unchanged, which I think is obviously very positive for the market, notwithstanding the backdrop. I think it's also worth noting that issuers generally do put a buffer in there anyway above the minimum agency requirements. And again, obviously, positive from an investor's point of view. And where the agencies have altered things is they've required additional CE down the stack, purely driven by their increasing default rate assumptions as a result of COVID. Particularly below the BB rated notes. I think if you then look at liquidity, there's been obviously some changes as a result of agencies, of issuers, and also investor feedback. Now, each transaction is obviously slightly different from the next in terms of those sort of structural features. But I guess just to highlight some of the changes that we've seen recently, obviously in some transactions we've seen an increase in the liquidity facility, so that's probably no surprise. We've seen an increase in threshold rates, probably universally across transactions. That's obviously accounting for wider margins, but also accounting for liquidity stresses being applied by the agencies. We've also seen an increase in some retention mechanisms for some accounts, some transactions, some issuers. And we've also seen an increase in, not only an increase in yield enhancement reserve, but we've also seen a couple of transactions where the issuer has incorporated an initial deposit in that reserve to allow for a bit of upfront liquidity. Now, I think lastly, the changes we've seen, not so much structural changes, but we've seen changes to CPRs. And I think issuers have been very conservative in what they've done in this respect. Perhaps a little more so back early on in May, but they still remain very conservative. What we've seen is issuers really flatline the first 3 or 4 months with CPRs in the low teens, climbing to a level that really is still below that particular issuer's sort of historical average. So again, you know, I think all those features sort of combined really to create very defensive structures. And I think just picking up on Steve's point, that seemed to have attracted obviously not just domestic investors, but a lot of offshore investors as well.
Thanks very much, David. Todd, we've heard from Rob and Anne-Marie about what I think is quite an innovative vehicle, the forbearance SPV as we're calling it. And earlier today, the core documents were signed by the relevant parties. So could you tell us about the significance of this vehicle, its role and the benefits you see for lenders such as Bluestone?
Thank you. Firstly, I'd like to absolutely thank Rob and his team and Anne-Marie and you, Chris, for helping pull the forbearance facility. But even just going back a step, I think that the AOFM support of the market has been exceptional throughout this pandemic. I think through all of the areas that they could have helped with, and I think they've done it with a fairly deft hand. It's been very good to have obviously the support for primary for issuers, and you know, in our last deal, in the end, we didn't need that, but that is largely because of the support that they've given to get the market going. More subtly, the way that they have provided initially through the pandemic support for the secondary market, both in terms of switches and directly, that enabled investors to really price the market in an uncertain world. And that's given confidence for investors to come into primary issuance. So all of that is really helpful. I think the most creative and interesting is the forbearance facility. And really this comes down to, for a market such as ours, we've not seen or dealt with an issue like this. We thought that the GFC back a decade ago was the one that would be the big thing we need to plan for again. And this is a completely different animal in the sense that it is randomly affecting people's ability to repay, and it is making it very difficult to predict what was going to happen. And so what this does is, with comparatively a very small amount of cash, compared to the $15 billion that is available, what this has allowed the AOFM to do is to specifically target issuance and provide liquidity to those structures so that investors can have confidence that looking through the way the structures operate and looking through pre-pandemic to post-pandemic, that there will be a significant amount of liquidity support in essence, as if the COVID-19 hardships did not happen, or at least were delayed. Now, this is not a free handout. The industry, which is the right answer, the industry will absorb and pay this over time, but that's the key. This enables an issuer like Bluestone to confidently continue to lend to people who will be able to repay and underwrite, and it allows us to know that we will have funding available, and allows us to tell investors that we have a degree of predictability in our performance expectations for each of our pools. And I just discussing the forbearance facility has allowed us to go to the international investor community with confidence. And I know from speaking to investors globally throughout this crisis, just the mere existence of the forbearance facility is very, very much a gate opener for many investors, because they can see that our industry is being well and cleverly supported by the government. So for an issuer like Bluestone, we will be absolutely drawing on the forbearance facility and we think it's going to be a really solid part of our plans going forward.
Okay, thanks very much, Todd. We're coming up to time, David, so I might turn the crystal ball to you. And what can you say as your expectations regarding market trends we may see for the remainder of 2020?
Yeah, thanks, Chris. It's a great question. I mean, I think the unfortunate reality is that, you know, it doesn't feel like this pandemic is about to finish anytime soon. What does that mean for markets? Well, they're going to remain volatile and on high alert. I think really what I see going forward is probably a similar trend to what we've seen the last couple of months. I think the first, obviously, trend or non-trend, as you may wish to call it, is a lack of ADI issuance. So I think, unfortunately, that is going to continue for the next 6 months. As Steve flagged, look, ADIs have access to deposits. We know alone that in March and April, in excess of 160 billion was deposited at ADIs. In addition to that, they've got the TFF, and we also know that not a lot of that has been drawn down. So banks at this stage sort of feel well funded, certainly over the next 6 months. What does that mean? It means we'll continue to see non-bank and non-conforming issuers come to market. I think we're going to continue to see these defensive structures that I spoke about earlier with similar features in them. They certainly, as I said, seem to be attracting some good investor demand. Investors are getting comfortable with those structures. So I would expect to see those structures to continue. And I think the other thing I'd expect to see is, as Steve flagged, is just offshore participation. We didn't see as much offshore participation last year, certainly in the transactions Macquarie was on. This year we've seen that increase, and not just in sub-tranches, we've also seen it increase in the senior tranches. So we would hope to see more of that. And I think, again, as Todd highlighted, maybe the catalyst for more offshore participation is, in fact, the forbearance SPV, which sounds like it's ready to go. So really, Chris, it's probably more of what we've seen over the last 4 months to take us through to the end of the year.
Okay. Well, thanks very much, David. So we might conclude the panel discussion there, and we are sort of coming up to the end of the webinar, but we have received one question that's come through. So this one's probably for Sue Lin, if we can cue her to come back. The question is, do you think there's some positive outliers that might arise, such as an acceleration of the state economies in Western Australia and Queensland, where the management of the COVID-19 outbreak has been much more successful, and their economies are now sort of rebooting? Would you like to maybe respond to that, Sue Lin?
Sure. I think that is a fair observation, and partly related to that really is the commodity exposure of both those states. So iron ore in particular for Western Australia, and the coal side in Queensland. And what we have seen that has been a pleasant upside surprise really is the strength of some key commodities and iron ore. So it's reflected a number of factors, but we've seen iron ore prices probably double what the Commonwealth budget forecast had assumed. So I think there is an element of that resource intensive nature of those states being a positive and helping out there, and that will show through in some of their numbers. The fact that Western Australia borders are closed, control, Queensland obviously low numbers as well, and just opening up, and really I think that progress on the health front is really very key for the confidence story that I was talking about. So there are some positive signs I think in some of those states, but again we have to bear in mind that they are smaller states. They account for a smaller percentage of GDP and employment. The bigger concern will be around New South Wales and Victoria, and so from that perspective, I think we've got to be a little bit careful in terms of some of those smaller states. Absolutely, will take some upside surprise, particularly on the commodity side, but overall, it's still going to be challenging, and we are also mindful that we're operating very much in that global economy where, again, it's a fairly challenging and uncertain outlook.
Thanks very much. I don't think we've had any questions emailed in, so what we might do is conclude the webinar. So I'll just like to thank our speakers, particularly Rob Nicol from the AFM for giving us his time today, and the other speakers and panelists. You will receive a follow-up email with a link to this webinar and the materials that have been used. And I would also like to mention that the latest edition of our journal, the Australian Securitisation Journal, is now available on the ASF website, which is securitisation.com.au. So in conclusion, thank you for joining us. I hope you've found this useful. If you do have any further questions, please email them through or request for information to asf@securitisation.com.au. I wish you well and hope you keep healthy. Thank you very much.